Welcome back, everybody. This is Edwin, the Magic Engineer, and I wanted to go over bubble detection because I think that's a pretty big topic, and I think that there's basics that a lot of people don't understand, and some of you who have surfed onto my channel and found it based on like finance things, like maybe through Gregory Mannarino or something, you might be familiar with all these topics before, so go ahead and feel free to just skip past this, but maybe I've got some basics to lay out for people that are new to investing and detecting bubbles. And before I get too much into it, I really want to say that detecting when something is in a financial bubble is a very inexact science, because there's a huge part of it that comes down to psychology. And there's the reality of whether or not investments are good or bad. And then there's the psychology of how people actually act and react to things. So you can predict the fundamentals, but you can't really predict the psychology. And the psychology is really what determines when something actually pops or not. But the psychology looks at the fundamentals, and so it's important to kind of pay attention to both of those. So what I want to kind of go over is some different topics. I'll go over stocks, bonds, real estate, and magic gathering, because I'm the magic engineer. I like to go over magic stuff. So anyways, the thing I want to talk about with stocks is I want to talk about PE ratios, because that's not something that people seem to be really familiar with. I mean, a lot of people are familiar with the fact that a PE ratio needs to be fairly low, and so they know kind of like where it needs to be, but they don't really understand why it needs to be low. And what a PE ratio basically is, and this part most people know, it's price to earnings ratio, right? And if that's what you're going to be focused on, then just like you would expect, if you take the price of a stock divided by the earnings of a stock, you're going to get a ratio. And let me be a bit more specific to kind of put some numbers on it. Let's say company, Acme Incorporated. You add up all the shares of stock. Say maybe there was 1 million shares of stock, and they were all worth $10 each. So the price of all of that stock is basically 10 million, right? That's the total price of all the stock. If you bought all the stock, you'd be forking out $10 million, right? And Acme Incorporated, let's say that they're a pretty solid company and they earn $1 million a year. So what you've basically got is a PE ratio of 10. Because it's the $10 million of the price divided by the $1 million of the earnings, right? The reason why this is important is because PE ratios tend to kind of like move inside of like a channel, and usually they don't get much lower than like anything like, they're not going to get much lower than 10, honestly, these days, right? But in the past, if you had a PE ratio that was somewhere up like around like 30, that might seem to be like a bad thing. And the reason why is, if you think about the meaning inside of this, if you're going to give $10 million to buy something, and it's going to earn back $1 million every year, well, that means it's going to be this is basically 10 years before that investment actually pays for itself, right? And if this investment changed to something much lower, like let's say it went to like $50,000. So it cost you $10 million to buy the stock, and it only made $50,000 in that year. Well, that's going to be a PE ratio of like 200, which basically means it's going to take 200 years for that investment to pay you back for actually buying it. So that's why things were in this channel. Because, what's an average person's lifespan or their investment lifespan? You don't even buy bonds usually, or want to buy bonds for much more than like 10 years, unless like the ratio, the payment's really good, right? So that's why a PE ratio of 10 was something that people would shoot for, and a PE ratio of 30, because maybe that's the whole time when you're actually going to be willing to give your money away before you actually need it back, right? 30 years. So once this is understood, it starts to become clear. I really didn't write that very well. Let me write that better. Ratios. It starts to become clear why some of these companies, why their PE ratios are all out of whack. Let me give you some numbers. If you look at JP Morgan Chase, that's a bank, right? If you look at their PE ratio, I've got them written down here for notes to myself. The PE ratio of JP Morgan Chase is 14.6, right? Not too bad. That's fairly in the middle of the channel, right? You look at a company like Apple, which is a pretty good company. Their PE ratio is 19.6. Also pretty decent, right? Not too unhealthy, right? If you look at Intel Incorporated, they're also 14.6 right now. So you start to see a trend, like a lot of these big Dow industrial companies, you know, the S&P 500 kind of stuff, they have pretty good ratios, right? But some stocks are very hot and everyone's talking about it, but the PE ratios are really bad. I'll give you two examples of some ones that are pretty bad right out of the get-go. If you look at Netflix, the PE ratio of Netflix is 202. And the PE ratio of Amazon, this one's really bad, is 282. So if you were to buy all the Amazon stock that exists, it's going to take 282 years for you to be paid back. And I'm willing to guess most of you are not going to live that long. So the thing is, investors in the past, they would see something like this and be like, oh my gosh, that's a terrible PE ratio. That company's not making any money. I'm going to spend all this money buying the stock and then I'm never going to be paid back. But what happens is something else comes into play that's making people kind of lose their minds, right? And that thing is kind of like the movements of the stock market recently. And so like look at like the Dow, it's kind of gone like this, right? And this point in time right here, this was around, let's see, I wrote this down, January of 2000. Now that the Dow came up, I'll write this here, the Dow Jones, which is an indice. The Dow Jones came up and hit a peak of around like $11,700 per share, right? In January of 2000. But then the dot-com bubble broke and the Dow kind of went sideways for a bit and then fell. And then it rose up again because the government lowered interest rates for like home buying and things like that. And that spurred on the market and they tried to artificially create a recovery. And the thing that I find interesting is people would say, oh, this was a bubble, right? But if this was a bubble, then what was this peak here? Because this one came in about $14,000 per share, and that peak was hit in October of 2007, right before the 2008 crash, right? So everyone said that's a bubble, but then when it was coming up to here, analysts, like in all these points in time, all throughout here, were like they were not sounding the alarm bells, most of them. They were not saying it was a bubble. But then after it popped, what did you hear afterwards? Everyone said, oh, the stock market bubble, the 2008 crash, it was all in the bubble, right? Well, then you look at where it's at today. So right now it's November of 2017. The Dow is now 23,500 per share, right? And so it's just funny to me that people said that was a bubble, but then this is reality. And then they didn't say it's a bubble, Oh, okay, afterwards that was a bubble. And now we're way higher. And what did we have in all this time? Well, you had the quantitative easing, the bailouts, and the quantitative easing 1, quantitative easing 2, quantitative easing 3. Low interest rates were maintained throughout this entire time. So all this government and central bank artificial stimulation shoving things down. And people even today are saying, oh, it's not a stock market's not a bubble, right? This has all been priced in, that they like to say. So this is not a bubble. But, I mean, reality is probably more something like this, right? Because, we only have so much population growth. You only have so much land use. You only have so much actual productivity of things. The real stock market value is probably something more like 12,500 at this point, based on growth of where the world's actually at. So a pullback, this is probably reality, right? And the reason why I show all this is a PE ratio is supposed to make people weary, but what happened is like everybody gets to this crazy mentality and then they lose their minds on what they should be investing on and shouldn't be investing on, and then something like this happens, and the only reason why people keep putting money into it is because it kept going up, right? So let's leave that PE ratios and then maybe have like the stock one, gov intervention. Maybe I'll put government intervention on there too, because government intervention is what caused the stock market to go back up. So in bonds, what's going to be a bubble, or what's going to be, sorry, this column I should have here is kind of like the reality of the market. What's going to be what causes the bond market to move into a bubble or have an issue? Well, bonds are all about, you put money into bonds if you're wanting to like have money invested and just have passive income, because you put money in and then every 6 months they give you a payment, right? And it tends to be a pretty good thing. So with the bond market, let's do this in a different color. Let's say you're going to buy a $10,000 bond and you're going to give it to the government for 10 years. And this specific bond you're going to buy pays 2%, right? And that 2%, well, that's going to work out to $200 a year that they're going to give you. But these, they don't compound interest. They just basically give you 2% of the principal and 2% of the principal every year. So it's going to be 200 10 times. So it's basically going to be $2,000 that you get at the end, which basically works out to, this is how much money, sorry, right there, that you will get back. So you give the government $10,000 and 10 years later you get back $12,000 because you got 2% every year, right? That's a 10-year government bond, right? Now the thing is, inflation is really where this guy comes in. So it's interest rate versus inflation. That's really what the bond market all comes down to. And the reason why is kind of tricky. Let's say when you bought that 10-year bond, the inflation rate was like 1.5%, right? And so that means like the purchasing power of money, that $10,000 every year buys a little bit less, right? So if the inflation rate is 1.5% for the next 10 years, then what that works out to be, let's see. Okay, so that's going to be $11,605 is what that works out to be after like 10 years. So basically, like if you put $10,000 in, you would have to have this much money 10 years later to equate the purchasing power of what $10,000 could previously. So if you bought a $10,000 bond and you got back $1,200, at 1.5% inflation, you've only barely beat inflation. You've barely made any money. The difference between these is your actual profit, because you got to look at inflation. So that is already a problem, right? Well, if this goes to 2%, then that number becomes 12,190. So at 2% inflation, now that 10-year bond at $10,000 and 2%, it's basically lost, right? The money you get back is monetarily, it's more, but the amount of things you can purchase is actually a little bit worse, right? And the reason why the bond market goes into a bubble is because for like 30, 35 years, the interest payments that the government, the US bonds have been paying has been going down for like 30, 35 years for a long time. And the thing is, at some point, the interest rates that they pay, the 2%, is eventually going to spike back up. And when that happens, all the people that currently hold bonds, they're going to have a big problem, right? Because inflation goes up and bond rates go up, and no one's going to want to pay any money for that actual bond. Point in fact, if this went to 5%, if inflation became 5%, then what that number becomes now is $16,288. So basically, in order for, you would have to have $16,288 in 10 years to be able to buy the same amount of stuff that you could buy 10 years previous with $10,000. If you can't beat that number with your investment, you're not making any money, you're losing money. And so the problem is when inflation spikes up and bond rates go up, then people who have that $10,000 bond that's only paying 2%, well, they don't want it. They want to get rid of it. And so everyone in the bond market is going to be selling, right? But the thing is, no one's going to give you $10,000 for that bond. They're going to give you much less. In fact, they're going to math it out, and they're going to say, this is how much money I'll give you. And so if you sell me this $10,000 bond that pays 2%, I'm effectively at the end going to get the 5% that I'm actually wanting. And for $10,000, that actually works out to about $7,184. So the worst case scenario, to kind of put this all in perspective, you go out to the government and you say, here's my $10,000 because I'm going to buy that bond now. Isn't this great? I'm going to make 2% a year. And then, like, say the next day, inflation kicks up, Fed raises rates, everyone's freaking out, right? And the next bonds that are paying are all paying 5%. And so the next day you're like, oh my gosh, I don't want this bond either. I need to sell it and put my money into something else. So you go out to the market and you just gave the government $10,000. The government's not going to give you your money back. They're not going to give it back to you for 10 years. And some other investor says, you know what? I'm not going to buy that at 10 grand, but I'll give you $7,184. And that's why everyone that's bought all these bonds, if inflation kicks up because the federal funds rate goes up, the interest rates go up, the bond rates go up, then everyone's going to want to sell their bonds, and there's just going to be a huge sell going on, and that's going to be what pops it. So it's interest rates versus inflation is what people need to watch. That's the reality for detecting bubbles, right? So if you think that's going to change, is what you're going to watch. Okay, maybe we'll do black for this one. So for real estate, for this one, and this is, I've covered some of these in my other videos, but I think this is for the topic of bubble detection. I'll just go over them here again. So for real estate, what this one is really going to come down to is I'm going to say local income versus monthly mortgage. The reason why that's it is, and again, like I was saying, detecting bubbles, there's a lot of personal opinion in here. If everyone can have their own opinions on what they think that makes sense, but here's my take. When a couple goes out and says, we're going to go buy a house, what they're going to look at is they're going to be like, hey, honey, how much can we spend every month on this mortgage? And maybe the husband says, I ran the math, sweetie, and on the mortgage itself, this is how much money I can put in to actually buying a house. I can't put any more in. I don't make enough money at my job to afford any more than that. That's all that I can actually put into it. Let's say at the time this actually goes down, there's a $500,000 house. And let's say these guys were really good. They were very frugal. They've actually saved up $100,000 so they can make that 20% down payment, which, by the way, almost nobody does. But let's just say that they did. And so they put in $100K. And so the loan they're going to get is $400,000. And today they're going to be doing the 3% interest rates, right? So they're going to borrow $400,000 at 3%. When you work the math out on that, it works out to about $1,686 a month just for the mortgage payment, right? And so they'll look at that and say, yes, honey, we can afford that house. Isn't that great? So they buy the house. They've got the house now. They're making their monthly payments, and it's a fixed rate. It's not adjustable, so like how the 2008 crash isn't going to hit us. So they feel safe, but remember what they did is they looked at their income afforded this amount of money, and that's what they got their mortgage based on, right? But then guess what happens? Then the next housing pullback happens, and because interest rates are going up, and when interest rates go up, what happens is this rate is going to affect that monthly mortgage, right? And if you work the numbers backwards, let's say you still only have this much money to spend. And so you're going to start somewhere about here, and I've actually got the math worked out already. Let me find it. Okay, so for $1,659 a month, which is close to that number, right? You're going to be able to borrow $224,000, and you're going to have $56,000 to put down, and that will only purchase you a $280,000 house, right? So big point is, because this was, oh, sorry, I should have mentioned, this was at 8.1%, which is, by the way, that's much closer to a 100-year historical norm for interest rates. Even in the 1980s, it went up to like 20%. A lot of people don't know that, but that's true. So anyways, so the interest rates affects the monthly mortgage. The Fed raised rates, everyone raised rates. The rates went to 8.1%. And with that much interest they're paying every month, in order to hit that monthly payment, because that's all that they could afford, the maximum house that they could afford now is $280,000. So a $500,000 house became a $280,000 house just because the interest rate went from 3% to 8.1%. So to put that in that little situation, that the husband and wife, they bought the house at 500 grand, they owe $400,000, and they took 100 grand that they had in cash and they put it into this house. And they're feeling good because they've got this monthly mortgage, but then the whole market drops, interest rate goes up, and now they've got a house that's only worth 280 because everyone else around them was selling their houses, and so the appraisal value went down. Their house is only worth 280. They still are making their big payments, right? Their $100,000 that they put into it, it's gone, right? They're not going to get it. Even if they sold it, the bank's going to claim the first money and you get what's left over, so that money's gone. So that's why interest rates going up can cause like a housing pop. And that's why it relates back to detecting bubbles. Once you understand this, you understand that interest rates is what allowed housing prices to come up. And when interest rates go back up, housing prices are going to have to go back down. And that's why the Fed can't actually raise rates. So when you're detecting bubbles, what you're looking at for real estate is you're looking at the income in an area, and you're looking at what that monthly mortgage would be in that area, right? If you go to like Santa Clara and it's like the average household is making $80,000, but the average monthly payment for a mortgage in their houses there are like $1 million to like $2.5 million for like even like some decent size homes, some normal size homes. I mean, you're looking at like these huge payments, right? Like, $8,000 a month, $12,000 a month, these enormous payments. $80,000 a year, can't afford that, right? And that's why there's a problem there, and I personally think that is a sign of a bubble, right? And the only reason people keep buying these houses at the moment is because the prices keep going up, but everybody basically lost their mind. Okay, so that's house prices. So Magic the Gathering, and this is in here, so all you finance people might check out. But I'm going to do this because this channel is definitely about like doing Magic the Gathering stuff. So what I say on this one is, this is the best that I can come up with. The sold prices, so what cards have been selling at, if you can look at those historical values that they've been selling at, not what people are asking, well, cards are actually selling for. And then you couple that versus the supply. Like I've seen times where cards start spiking in value, but then you'll see like a huge supply of them come onto the market. Like you'll look at Star City Games or you'll look at TCG Player or something, and all these stores have all these copies to sell, and they're all going to compete with each other, and they're all going to price it down. Or you look on eBay and there's tons of auctions, right? When I see that, I basically in my mind think the price of that card is going to come down. And if I needed like a playset of some card because I was going to build a deck around it, and there's a ton of them flowing into the market, I sit back and I let everybody compete, bring that price down, and then I'll actually move in. The sold prices is a tough one because not everybody reports them. I mean, if you go to like a website like Troll and Toad, Star City Games, whatever, then whatever the price they're asking is pretty much what it's going to sell for. But on eBay, you can't look at like the price of the auction. You got to like go to the advanced settings and click the completed or sold listings and see what these things actually sold for. But a lot of the real high-end stuff that's sold very privately and kind of hush-hush behind closed doors, like you never really know what they actually sold for. So that's a really tough one to gauge because you don't have a lot of data on sold prices, and the supply is sometimes kind of tough to gauge too. So what people tend to do is like, this is what I try to look at. Sometimes I can get data on it. Most of the time you kind of just go with your gut and you look at like the card, how good the card is, and you look at like how many people are playing it versus like how many people seem to be buying it, and you kind of just make an experience call on it. But this one, there isn't an awful lot that you can really go on, but those are the things that I actually look at, right? So I think all of that is really important to kind of go over, because if you're trying to detect a bubble in some kind of investment, the reason why I put all these on here is because I want to make this very clear separation. There's reality on where things should be priced, kind of based on supply and demand, right? And then there's speculation and excitement and kind of the greed fear index. And that's what this is all about, this market price column, right? So if you look at if everyone around you is saying, this stock's a great stock, go buy this stock, the greed kicks in, everyone sees the gains and they want to get into that, right? The greed kicks in, and the speculators, they know the greed's going to come in, and then they front run because they know the greed's going to come. There's this whole greed fear thing, right? And then as soon as it starts dropping down and people lose that faith and then they just dump it, then that price is just going to fall. So that happens in all of these markets. And that's why I kind of drew this column here to be just kind of like the same across the board, because you got people that front run markets, you got speculators, you got the greed fear index, and any one of these things, it exists. Stocks move, of course, very quickly. Magic can be pretty liquid, move quickly. House prices don't. One reason, and this is maybe like worth talking about, what causes house prices to go up or to go down, the resistance to it, I should say, is, let's say you're going to buy a house, right? Let me give this example. Let's say you're going to get a $300,000 house, right? And the house appraises at $300,000, but there's all these other people that want it too, and you really don't want to lose the house. So one guy offers 320, another guy offers 350, another guy offers 330. Well, of course, the sellers are going to want to select this one, but sometimes they don't, and which would seem really odd, right? You just select the best one. Well, the reason is everyone these days is borrowing to buy the house, right? Most people are borrowing 90% or more money to actually buy the house. Well, where's this money coming from? It's not from you, it's from the bank. The bank's the guy that's putting up all the risk. If the bank looks at this house and says that house is only worth $300,000, the bank's not going to loan you $350,000 to buy a $300,000 house, because if you don't pay them, they're out this much money. So what will happen sometimes is maybe this guy offered $350,000, but someone looked at some stats for that seller and thought, this guy is not going to be good, so they don't go with him. They go with someone else. And the reason is that extra $30,000, guess where that comes from? Out of your pocket. So if there's a $300,000 house and you offer $330,000, at the time of closing, they not only expect the down payment, not only that, but they expect you out of pocket to come up with an extra $30,000 cash and put it into the house. Now that, for a lot of people, is a lot of money. And a lot of people don't have that much cash on hand, and that's what stops houses from going up too quickly. And there's something also very similar that happens for houses going down. They're not going to go down too quickly because, nobody wants to drop their house prices, not until they're really sure it's not going to sell or until they're forced or something. So you've got these forces resisting. So stocks and magic can move much more quickly, but real estate is not going to, because of this whole appraisal process thing. The bond market technically could move pretty quickly. But the thing is, the bond market is all based on the inflation rate, like the CPI, and it's based on the federal funds rate. And those things, that central banks usually don't make rapid changes. They have in the past, and they regret it every time. So they don't tend to make big changes, but that's what affects bond rates. So anyways, that's my viewpoint. That's what I look at when I'm trying to figure out, is this thing in a bubble or not? And the big key learning that I've taken away from investing over my short years is, even when the fundamentals say that something is a bad investment and you shouldn't buy it, the speculation, this column ends up mattering a whole lot more. And even though a stock really should, maybe here is where it should sell off at, and if you know all these dynamics, a lot of people will sell here, but then people can just be crazy and they can just keep going up for years and years and years. So you just got to expect that. But no, all this distance here, this separation here, this is nothing other than psychology. That's all that is. So that's all, the fear and greed index of people on the market. That's all psychology, and you can't speculate that. So you just kind of got to watch how people are feeling, right? But you got to also know where your baseline is. So that's it, everyone. I know that was kind of a long video. I hope it was informative. I hope you guys liked it. And please give me some comments below. And also, if this video looks a little better, I'm using a new phone. I got rid of my Apple and got an Android phone, the Galaxy S8. So maybe this looks better. Anyways, thank you, everybody. Bye.